UK equity income's a popular sector, but how do the closed-ended funds stack up against their open-ended peers? I'm Mark Coggett, and this is Investment Trust Edge. To discuss the topic, I'm joined by three experts. They are Matthew Hose, Vice President, Investment Companies Research, JPMorgan Cazenove, David Willcox, Investment Director, City Asset Management, and Lee Robertson, CEO of Investment Quorum. Lee Robertson, how do the open-ended and closed-ended fund sectors compare when it comes to UK equity income?
Well, closed-end has outperformed, I would say, by quite a low margin over most time periods. In fact, maybe all time periods. So I think that's the first and foremost thing, and I think that's all to do with the gearing that's available. I think closed-ended seem to be smaller, as we said before. They're a bit more nimble, the bigger opportunity set. So I think that's the biggest comparison. They've outperformed.
Would you go along with that, David? And is it just down to gearing?
I would agree with some of that. I would say that if you take the 5-year numbers, the outperformance looks quite significant. If you actually run those numbers over the 10-year period, it falls quite considerably. Difference is about 14%. And the reason for that is you need to take into account a bear market and a bull market. And so you've got a situation where in bull markets, the leverage helps you a lot. In bear markets, it can be a real challenge. So you need to take into account both sides of the equation.
Given that even over 10 years the investment trust have done a bit better than the open-ended funds, how does that affect the price or discount that you need to be attracted to a closed-ended equity income fund?
For us, it would mean that we would have to have a substantial discount, or especially relative to history. So we would need at least double digits, I would assume, for it to be appealing to us. Conventionally as a firm, we like to use open-ended funds for liquid assets, and where closed-ended funds are in liquid assets. So we are quite suspicious about boards' ability to return capital to you and to investors when discounts are in existence.
Matthew, looking at the closed-end UK equity income sector, is there much consolidation in it? I mean, I'm just sort of wondering, if you look at the sector average now, might it be because a lot of the poor funds have just been stripped out, so there's a sort of survivor bias built into it?
We haven't tend to lose many funds from that sector. You could argue there's potential for consolidation there by some funds being run by the same manager in that sector, but I think we haven't seen that potential realised.
Well, given that, why haven't shareholders got together and got some of these trusts to be merged, given they're all run by the same fund management group?
I think there's various one-off costs involved with mergers. There's also the issue where wealth managers may have limits on how much of a trust they can hold, and if they hold 5% of one and 5% of another, and they can only hold 5% limit, then by putting the two together, there might be an issue there as well. And there also might be some resistance at the manager and board levels as well, obviously combining products.
But how much, as an investor, how much time would you spend sort of campaigning on an issue like that, David, should it arise?
I think it depends on the trust. I think it depends on the situation. We have been active in the past. We have made our case clear to management and boards where it's been necessary to do so. I think there are also times when the level of resistance that you receive from board is so significant that it isn't ever going to be appealing to you. So, there's sort of situations that we try and avoid. You find that trusts with good corporate governance histories tend not to have these problems. So it's something that we consider before we make an investment.
And are there any managers in the closed-end space, Lee, that you really rate and respect, who just don't have an equivalent open-ended vehicle in the UK? The IMA's UK equity income space?
I'm not sure, to be honest. I mean, people we like. We like Nick Train over at Finsbury's. Of course, he's got Linsell Train, but I'm not sure about one or the other. We tend to if we, as has been said earlier, if we like the governance, if we like the objectives, if we like the asset class, then that's how we'll invest. It's not whether they do or don't also have an open-ended fund.
And you mentioned Nick Train there. He's obviously got the closed-ended fund. Has he got an open-ended fund there as well?
Well, he's got Linsell Train. He's got UK equity income. So yeah, he does.
And what about, David? I mean, a group like Henderson is probably not known for being a UK equity income player or a major one in the open-ended space. Yet, if you look at the closed-ended space, they've got couple of trusts in there, and they're quite big ones with very long track records. How does that happen with a group?
I think it happens for lots of different reasons. I mean, you've got corporate histories of the trusts. You've also got the corporate histories of Henderson themselves. Having been quite active, taking over businesses. So you can end up with these sorts of portfolios, which perhaps looking at them today look quite strange in terms of different products, but actually are just a force of history.
So is it actually quite a good example of how a board can make a difference to the ethos of a portfolio?
I think it is. A board needs to act in the best interest of shareholders. That is the absolute key prime responsibility of the board, and they need to consider whether the fund management group that they currently have hired, regardless of whether the product has your name on it or not, is the right manager for the trust and the shareholders over the long term. So it's something that we hope boards are becoming more active on, and I think generally they are, but it's been a slow process.
And talking about active, Matthew Hose, how active are the fund managers in the UK equity income sector when it comes to investment trusts, or are there some sort of quasi-trackers in there?
No, I think it's worth noting there's a range of active shares in that, and by active share I'm talking about the percentage that the portfolio differs from the benchmark, which in that sector is the FTSE All Share. That ranges from up to about 95%, which is that'd be Finsbury Growth and Income. So Nick Train, as we just mentioned, all the way down to some other trusts where the active share is only 40 to 50%.
Okay, so you can actually, and 40-50%, is that, for those that don't know, is an active share, is that pretty low? Is that quasi-tracker, or
no? I think you'd have to get much further down to become quite a quasi-tracker. But I think that the important thing is the dispersion within that group is that some are very active and some are less active.
And is the open-ended sector a little sleepier than that, David?
I would say that there are much greater number of open-ended funds versus the closed-ended space. So I would expect that the ranges are probably broader. I should think probably there are more quasi-trackers in the open-ended space than there are in the closed-ended.
So, Matthew, you want to come back in there?
But the open-ended sector, I think that's right. The open-ended sector generally has, on average, a lower active share. No, not that much lower, but slightly lower. And I think we find that is because, obviously, there's a lower range of assets they can hold. For example, it's more difficult for them to hold mid and small cap as opposed to investment trusts.
And what are the sort of, in the equity income space at the moment, Lee, what are the sort of strategies that have started to look very attractive over, say, 3 and 5 years? I mean, is it essentially the guys who are very bullish on equities who are top of the tables at the moment?
I would say so. On the flip side of that, you could look at, say, Invesco Perpetual, who've maybe been slightly duller over the last period. Performance not quite so there, but if they've been holding stuff like pharma, so if pharma does come through, and that's very flavour of the month at the moment with potential mergers, then that might begin to come through. So I think those are plays that are shaping out quite well.
Okay, and David, what's your sort of thought on the themes that are just driving that sector overall at the moment?
I think if you look at the data, it will be small and mid caps that will be driving performance data. So those managers with a greater allocation to those sectors, even within the income sector. So something like Gervais Williams Diverse Income Trust, where you've got a very different portfolio structure to conventional fund, but because he's trying to expose the portfolio to income producing small and mid caps, and I think that's going to be a big driver, or has been. Whether it will be for the next 3 years is a totally different question.
Now, Matthew, one of the things, I think last time you were on Investment Trust Edge, a while ago now, we were all talking about the ability of investment trusts to pay dividends out of reserves, to pay out of capital. Is that a real, genuine advantage for equity income funds these days?
It is,
or
yeah.
Is it
I mean, we've talked
nice
about
in theory?
We've talked about almost every investment trust has both discount risk and poor liquidity relative to open-ended. But I think having the potential to use revenue reserves, and now a number of trusts have the ability to distribute capital directly, is a big benefit. One dynamic we're seeing in the UK equity income space at the moment is the impact of dollar dividends, given rising sterling against the dollar, and that's diminishing the effect of dividends from things like HSBC, BP, which are paid in dollars. So that allows investment trusts to weather that impact much more than open-endeds.
And have you seen a closed-ended equity income fund pay out of capital for dividend yet, or is that something that's not happened?
Not yet, but they haven't needed to yet. Yes. So we're still seeing earnings growth in the UK markets, and we're still seeing dividend growth as a result. So if that was to change, we might see some use their capital dividends. But in reality, I think they're more likely to pay out their revenue reserve than use that capital dividends as almost sort of break glass in case of emergency type of thing.
All right, and in the open-ended fund space, Lee, over the last year, there's been sort of, you hear the occasional rumble that there are trusts in the open-ended UK equity income sector that aren't quite paying out enough income. Is that, in the open-ended side, is that a problem for you if you're investing in those funds on behalf of clients?
It could be, but I think there's a wide enough range that we tend to choose the ones that are paying out. I mean, of course, then you get this concentration that we're all been talking about, but it hasn't been a huge problem as yet, but I think it's heading that way.
Okay. And again, in terms of revenue reserves, I mean, what point in the cycle do you expect to see trusts paying out from revenue reserves? At what point, if they're doing it, do you think, actually, that's a bit worrying?
It's going. If it happens, it'll be when things are most difficult, it's just inevitable because dividend flow will have greatly reduced, and that's something that we need to consider and investors need to consider about how that impacts them and how they take on board that risk at that time. What I would say is it seems unlikely to happen in the UK equity income sector anytime soon. I think you have seen it. People paying out of capital in different sectors. It's happening in private equity. We saw RIT Capital last year increase their dividend quite significantly. It has a lot of equities in it, but it also does private equity and property. But they felt they needed to grow their dividend beyond what they could distribute normally.
Okay, we're almost out of time. Lee, if I could come to you first, a final thought for everyone. When you look at the closed-end fund space for UK equity income, do you think equity income is priced about right, given that the sector itself is quite a lot of trust in there on a premium?
It feels slightly frothy to me. I don't think earnings are quite feeding through the way we might have hoped in the recovery, although everyone's talking up the UK recovery. So I think it feels slightly frothy to me, but it's not far off right.
I probably wouldn't disagree a great deal. I think that there is a little bit of overvaluation in there, but given where we are in the interest rate cycle and the sources of available income for clients, you can see how a case can be made. I think in the short term we'd like to see it a little bit cheaper.
Yeah. Matthew?
I mean, I think it's worth remembering that in 2008 that sector re-rated very quickly when interest rates fell. So I think, as we've already alluded to, there's potential for discounts to widen as interest rates start to increase. But for now, I think there's some value there, and particularly in certain names, so it's worth looking at that list.
We have to leave it there. Matthew Hose, David Willcox, Lee Robertson, thank you all very much.